everybody. Thank you for joining us today for our second inaugural BizTax webinar. I'm pleased to be here with my partner, Namir Hallak, out of our Vancouver office. Good morning, Namir.
Good morning.
Good morning. So today we're going to take you through some of the basics that you want to keep in mind when looking to expand your business to the U.S. And we're going to really talk about what does expand mean, because I think there's a little bit of misconception in what that might actually be. So you know, throughout the webinar, there's going to be 3 polling questions. And the reason for this is we're now certified under NASMA in order to provide CPE. And so in order to receive that CPE, you must participate in the polling questions. If you have any questions that come up throughout the webinar, please make sure to put it in the Q&A part. We do have a couple of our managers, Gina Ming and Min Zhang, who are moderating and monitoring those questions. And at the end of the webinar, we'll circle back and have some time to answer 3 to 4 questions. And Gina will come online at that point in order to pose those to Namir and I. There will be a survey that you will receive at the end of this webinar. I ask that you please take a few minutes to answer that survey. Let Namir and I know how we did today, as well as give us feedback on any other topics that you may want through our BizTax webinars or even our Tax 101 webinars, if that is applicable to you. And finally, if you need closed captioning, there's a little button on your screen that says live transcript. If you click that, it'll come up and you'll have closed captioning as best as it can be of our webinar today. So throughout today's webinar, our agenda is focused on what aspects you need to keep in mind when expanding to the US. So first is defining what is active income versus passive income and how that affects you when you're expanding your business to the United States. How does the treaty play into this? We're going to go into that. We have talked about treaty in the past, but we're just going to go high level about things to keep in mind when you're expanding to the US, because how the treaty comes into play will actually help dictate what type of entity or non-entity you may choose to have when doing business down in the United States. We'll also talk a bit about the common legal entities that exist when you're looking to go to the United States, and which ones are good to use and which ones not so good to use. And then retaining versus distributing profits back up to Canada. What are the different ways in which you can get those monies back into Canada, into either the shareholders' pockets or the Canadian entity parent, if it's a parent subsidiary setup that you have for structure. And then we'll be talking about how, if say you're going down to the United States for a short period of time, what are some things you need to keep in mind about your end game when you may want to exit the United States or your entire business for that matter and sell the entire structure? And finally, the last thing is, how does expanding to the US affect your reporting in Canada? Because yes, there is additional reporting that will take place if you set up foreign jurisdiction operations. And so I'm going to kick it off today, and I'm going to talk about the difference between active and passive income. And so when you're looking at expanding down to the United States, they use this term called US effectively connected income. And what that means is generally when you are down in Canada uses the term carrying on business in Canada. So if we're using terms and we're trying to kind of put them together in our Canadian language, if you will, tax language, the term that we're looking at is effectively connected income in the United States. And where this comes into play is when you are earning an active type of business down in the United States, you generally will have effectively connected income. So passive. So if we were to think about what is passive income, in our world, passive income in the tax land is things such as interest, dividends, maybe even rents. Those types of things, when you're looking at expanding into the US, won't necessarily create an effectively connected income if you're not in the business of doing that work. So when I talk about interest, for instance, if you set up a company and let's say you're a mortgage lender, you're going to earn interest income. Well, now you're in the business of lending money, so that interest income might actually be considered active. So when you're looking at those definitions, you have to really, you can't just go, well, here's my definitive line. Interest income is passive and sale of property is active, because that might not always be the case. there is situations in which passive income can be deemed to be active income under the US laws for purposes of reporting. Now, when you're looking at the effectively connected income, why does this matter for purposes of US reporting? It matters because under US law, if you have effectively connected business income in the United States, you have to report it. Now, you may not necessarily be taxable on it, but you're brought into the reporting rules of the United States. So if I were to think of active business, you're selling products into the United States. You are potentially providing services of certain kinds into the United States and actually physically in the United States providing those services. It might be a bit different if you're providing the services from Canada. So you have to really look at every single step of the way through the effectively connected income to determine whether or not you're brought into the reporting rules. And now Namir is going to talk in a few minutes here about how the treaty plays into this. But what's important is to understand that as soon as you're deemed to have US effectively connected income, you're brought into the IRS reporting laws. And even if the treaty protects you from tax, you still have to report that. And if you do not report it, you're actually potentially subjected to a $10,000 penalty and denial of the treaty. And so you never want it. We call it an insurance filing, basically, this treaty protection return. And like I said, Namir is going to talk in a little bit here about what protects you, how does the treaty protect you. But what is important to know is as soon as you start making money in the United States with an active business, you're likely brought into the reporting regime of the United States. Now, we talked a little bit about states on other webinars. I'm not going to go too much into states, but keep in mind that states have a different rule, which is called nexus. So you have to look at the effectively business, and the threshold for states is much lower. So what I generally say to clients is the minute you start earning money from US customers, US clients, US anything, customers and clients are the general thing, you likely are brought into the reporting regime, unless it is passive income. And so that's why it's important to distinguish if it's passive income or active business income, because if it's passive income, there's withholding rules that apply. So you don't actually have to file a return. The payor will withhold dividends. Generally, the 5% if paid to a corporation, 15% if paid to an individual. Interest doesn't have withholding, so nothing on that, but there are different withholding regimes that exist for rents, royalties, interest, and dividends if it's considered passive income. And again, those rates are determined by the treaty. US domestic law says it's a 35%, so we always want to use the treaty to protect us against those higher withholding rates, because if you happen to file or have the US payer withhold at the domestic rates, then you're going to have to file a return to ask for a refund of that differential, because Canada is not going to let you have a foreign tax credit for that excess tax that was paid. So the moral of the story is the minute you start making money, even if you don't have a business or a legal entity in the United States, you're likely considered to be having effectively connected income that brings you into their reporting obligations. So I'm going to pass it over here to Namir for a bit, and he's going to chat a bit about what the treaty does to help protect you from taxation, even if you do have to report.
Thanks, Krista. That was a great kickoff. So, when we have these starter conversations with our Canadian clients, we're asking a lot of questions. We want to know more about their business. As Krista alluded, we want to say, we want to understand what kind of income are they making. And the next question is, how do you plan on making that income in the US? So once we know if it's active or passive, I want to know, how do you plan to do business in the US? So it's really about understanding what are your plans to expand to the US? And that can look very different for different clients, right? So that can be if they're going to sell or they're going to lease some sort of tangible product or maybe a software. Maybe they need to maintain some sort of inventory in the US. So they want to start sending salespersons down there or hire salespersons, whether they are employees or contractors in the US. Other clients might come to us and say, I think my Canadian employees are going to start going down to the US. They're going to start doing some work in the US, maybe providing services directly to US customers. Others are going to go to the more traditional route. They're going to say, hey, I think I'm going to purchase or lease a brick and mortar store, whether that's an office, a retail shop, or something more simple as just going to have a warehouse in the US. Or maybe they're going to go a completely different route and say, hey, Namir, we're coming to you guys and we want to ask you, I like this business in the US. I'd love to acquire this existing business. what does this mean for me? So the good news, as Krista said, is that the US-Canada Treaty does offer some relief for Canadian companies. So the business profits that you're going to have from your US business, they're only going to be subject to federal taxes, US federal taxes, if you're carrying on that business in the US through what we call a US permanent establishment. So what that means is that it's going to be really important as a Canadian entity doing business in the US that you can determine what business profits you have in your US from your US business that is now attributable to this permanent establishment. And the reality is, I'm going to dip a little bit more into what that means, but the reality is often our clients are, when they're going down to do business in the US, they're scaling their level of US activity. So they're first dipping their toes in US waters to very limited activities. Maybe they're just adding US facilities, they just want to store, display, or deliver goods for their US customers. Maybe they're just doing advertising in the US or whatnot. Those kind of activities, those very limited activities in the US, that will not trigger a permanent establishment. So,
and we did have a webinar actually on that a few weeks ago on digital services into the US. So if that's what you're doing, you may want to check out that other webinar.
That's right. That's right.
Yeah.
And if you don't have that permanent establishment yet, I really wouldn't be worried about setting up a separate US legal entity. Not yet, because you're not actually subject to US federal taxes at this point. Now, for purposes of this second BizTax webinar, we're going to assume that the Canadian business has actually exceeded those thresholds. You have a PE in the US, and we're at that point where clients are coming to us and they're asking us, how best do I structure my inbound cross-border business? So I'm going to go really quickly into just an overview of what those PE thresholds are, just so we have an overview of that. But again, there are other webinars we have dived a bit closer to the details there. But with a PE threshold, generally, it's if you have a fixed place of business in the US, if you have contracts that are being concluded in the Canadian company's name in the US, as well as if you are providing services in the US, and there's a two-prong test for determining whether, when you're providing services in the US, that'll trigger a US permanent establishment.
It's interesting because you talk about the fixed place of business, and a lot of people with the way e-commerce is working, one of the first things I generally do for my business clients is I go on their website and see where they list that they have offices. And if you're listing on your website that you have a physical office in, say, California, even though it's someone's home office, you are now advertising that you have a fixed place of business in the United States. So be very careful in how you have yourself present on the World Wide Web, because the tax authorities see that too. And you may not actually have a physical presence, but you might have trouble challenging that if you're putting your world out there saying, we have an office, or we have a store, or we have a something in the United States.
That's a great point, Krista. I think, a lot of times clients, when they come to us too, they say, hey, I think, I've started to sell to my US customers, and they're asking me questions like, is this made in the USA? Is your product actually an American product, or am I dealing with a non-US entity? And, even when they're looking at how do I establish a US presence, they might even consider having, for example, a virtual office or like a virtual mailbox. And while that might sound harmless at first, I've actually seen an IRS audit where they said, hey, we looked at your website and we saw this physical address in the US. It was actually a virtual office. They didn't actually have a physical space in the US, but they had questions, and then they had to answer those questions, and then obviously eventually revise our website to say, we actually don't have any US presence. So it's one of those things where it might seem harmless at first. It's just a virtual office. You're just getting mail there. But from an outsider's viewpoint, they're looking at your website and say, it looks like they have a physical presence, fixed office in the US. Looks like it's in New York too. It's a great location.
Yeah, so exactly. Or if your invoices say it's coming from a US address or anything, you really want to be careful what you're using for your address.
That's right. That's right.
Yeah.
And assuming now that the Canadian entity actually has a US permanent establishment. So let's assume they go down the route and say, okay, well, we know we're going to be subject to US federal taxes. But we're not really ready yet to set up a separate legal entity in the US. So we want to operate our Canadian entity doing business in the US using a branch. So that means you're operating directly in the US as a Canadian entity. It's through a US branch. that sounds initially to a lot of clients, that sounds great because it's simple. Maybe it's going to save you some time and money initially because you don't have to go down the administrative and maintenance costs of separate, setting up a separate legal entity. And the other nice thing about that too is if you have set up your business in the US, so it's operating through a branch, any losses you have from your US business can also be used to offset your Canadian company's income. Now, that sounds great initially. The issue with that is there is a short-term and long-term consideration that need to come into play. Firstly, from a short-term perspective, there's actually some level of complexity with how you do your branch reporting. So you actually do need to track your costs separately for a US business than from what you're doing in your Canadian business. And then the long-term issue is, what's your outlook for how you want to do business in the US? If your plan is to eventually incorporate that branch, so you say, well, you know what, this US business is doing great. I'd like to now actually take what's in this branch and put it in a separate legal entity. Well, the issue is if the value of your US business actually goes up, so then transferring those assets from the branch to an actual separate legal entity, to a US company, well, that's not going to be done on a tax-deferred basis because there's going to be an appreciation of that value, and that's going to get taxed in Canada. And then the other way to look at it too is if there are losses in that branch from your US business, it can actually be deemed to be zero because of the application of the so-called stop-loss rules. And again, depends on what's in the actual branch, what's actually in this branch for the Canadian business. But if you also have US real estate, transferring that real estate from your branch owned by the Canadian entity then to a US company likely will not be tax-free from a US perspective. Mm-hmm. So, and then before we dive into some of the questions around entities, what are the right entities? I'd also want to understand from the client's perspective for your US business, tell me more about your mind and management. Where is the decision-making for this business happening? So if we set up a US entity, who's actually managing and controlling the strategic direction and from where? And, a lot of this definition comes from common case law. So we have to ask certain questions like, where is the residency for the majority of the directors? Where are they meeting to make those decisions? And if they're actually making those decisions, are they actually just being told what to do from a Canadian head office? And so if you were to set up an entity in the US, but it meets these factors, it shows you that the mind and management could be in Canada. So if you look at this and you say, well, we've set up a US legal entity, but actually a lot of the mind and management seems to be in Canada, then we go back in the treaty and we look at the tiebreaker rules. And the reason for that is the US-Canada treaty is meant to settle these issues of dual residency. So the key there with the tiebreaker rules is to eliminate an entity from being exposed to income taxes in both countries. So essentially, it's resident in only one country. So if a US legal entity being considered is a C corporation and it's seen as resident in both countries, because, for example, there's mind and management in Canada, the tiebreaker rules result in the US company being treated as a US resident based on where it's incorporated, making it a non-resident of Canada. Now, one thing I just want to caution here is you do have to be careful of hybrid entities, which are viewed as one type of entity in the US and another type in Canada, for example, LLCs. And we'll talk a little bit more about that here in a bit. All right, we're going to jump into our first poll. So the US-Canada Treaty contains a tiebreaker rule to determine residency, such as place of incorporation, regardless of where mind and management is. True or false? Fantastic.
Fantastic. So what is it? Because we're like split down the middle here almost. Oh, it's lopsided.
Well, it's a good to kind of see both answers here because there is some nuances to this question. So the US-Canada Treaty does contain a tiebreaker rule to determine residency, such as the place of incorporation. And so consequently, the treaty residency of foreign affiliates of non-Canadian companies may not be affected regardless of where the mind and management abides. Now, there's an important but here. There's an important exception here to think about, and that is these tiebreaker rules do not apply for purposes of common law residency. And so we're going to talk about that later, and I know Krista is going to touch on that, is this will impact whether any dividends from the non-Canadian entity, the foreign affiliate, is actually going to qualify as tax-free. So even though the residency is going to be treated as a US entity, non-Canadian, the mind and management could also impact the dividend treatment for as being qualified as tax-free. All right, so we're going to jump into the legal entities here. So the next step here is we're assuming that the decision is to set up a U.S. legal entity. And the question that comes up is, well, what is going to be the appropriate entity for me to choose to do my U.S. business? And look, this is not an exhaustive list. But I think the first question that comes to mind is, how does Canada classify the foreign entity? And the important thing to remember here is that the classification from the CRA's perspective will determine, one, what are the reporting obligations? Are they at the Canadian entities level, or is it at the entity's Canadian member levels? And the second one is, what is going to be my Canadian income tax result? Are my Canadian investors going to include the income as the profits are earned? For example, if the US entity is a partnership and you have a flow through, or are my Canadian investors going to include their income as the profits are distributed? For example, the corporation, assuming the income is not FAPI, which we'll also touch on in a little bit as well. So if the Canadian investor has, for example, a US C Corp, and the CRA classifies this entity also as a corporation, that generally fits into that second category, which means that the Canadian investor is going to include their income as the profits as they are distributed. And what that means is that the Canadian investor then can't deduct any losses from that US entity as they are incurred. And they're generally only going to receive any Canadian tax relief for any US taxes that are paid indirectly. But there is a situation where you can have where the classification of an entity under Canadian and US laws could be different. And that can have a negative impact on the availability of tax treaty benefits. So, and what we're going to talk more about that a bit with the hybrid entities. But what that can mean is from the CRA lens, you can lose the deduction as a Canadian entity for any dividends that are received from the US. And then from a US perspective, if there is that mismatch of the classification of an entity, that can also result in a denial of deductions. And in an extreme case, that can also mean double tax of income in US, your source country, as well as Canada. We're going to dive into more of that in a bit. So if that's still not super clear, we're going to get into more of that here shortly. So let's dive into some of these entities that we see that come up quite regularly in our cross-border structuring. We'll start out there with the C corporations. So C corporations, they're formed in the US, C corporations in the US, they're formed under the laws of US states where they're going to be organized. So generally, what that means is that shareholders are going to have limited liability. They're not going to be liable for any of the corporation's debts. And, of all the entities that are listed here on this slide, really C corps are the only one that's actually a taxable entity. In other words, the entity itself and not its shareholders are the ones that are taxed on its income.
In its true form.
Correct.
Yeah.
And another distinction here between, I would say, US C Corps and how Canadian Corps are taxed generally is that the US C Corps are actually subject to double taxation. And what we mean by that is US C Corps actually don't have an integrated tax system like Canada, where the shareholders are going to get a credit for any taxes paid by the corporation they own. So essentially, it means that individuals can pay a similar tax when they own a business in their personal name or through a corp in Canada. That's not the case in the US. So in the US C Corp first pays a corporate level tax, and then the shareholders pay a tax on the after-tax profits that are distributed to them. So there's no actual consideration for corporate level taxes that are already incurred. Generally speaking, in the total US-Canada taxes that are paid through the ownership of a C Corp, we would say would be more than a flow-through entity, but that's oversimplifying. And again, there's a lot of drivers to consider why ownership of a corporation could give you, for example, a more optimal result. Next, I'll jump into S corporations. So S corporations, these are also separate legal entities. They are organized under state law. The way S corps work is that a US federal election is filed, and that's to treat this corporation like a flow-through entity. So that means it's not going to be subject to double tax or the corporate rates in the US. And so essentially, the shareholders of the S corporations are the ones that are actually responsible for the tax burdens of its profits or losses. Now, some of the requirements to have an S corporation is all the shareholders of the S corporation have to be natural persons. So it can be a C Corp, for example. And all the shareholders also have to be US citizens, lawful US permanent residents, or US residents for tax purposes. And there are some complexities to consider here. If you have a US citizen, for example, that is living in Canada and owns an S Corp, there may be a double tax exposure, but there is an opportunity to look at the US-Canada tax treaty for some planning solutions and relief on this as well. Now jumping into limited partnerships. So limited partnerships, these are partnerships, they're created under state statutes. They are flow-through entities. So that means that the income and the losses and any other tax attributes are going to be allocated up to the partners. Now, the limited partners, they're going to have limited liability for the debts of the partnership. And, when we're talking to clients often about how they want to structure their cross-border business, and, for example, they want to have that flow-through treatment. One important question we have to bring to the table is, whether the Canadian investors are going to actually be actively participating in the management of this business. And the reason we bring that up is from a limited partnership perspective, you may lose this protection, this limited liability protection, if they are actively participating in the management of the partnership. Now, that's a legal question, not a tax question, but it's one of the considerations you need to bring to the table if you'd like to have that flow-through treatment. Now, the other requirement with limited partnership is you do need to have a general partner, and that general partner will have unlimited liability for the debts of the partnership. And often when we're structuring this, you'll see that the general partner will often be also a limited liability entity that's set up. So that could be a corporation, or that could be, for example, an LLC. So the end result there really is, if you're a Canadian partner and you're in a US limited partnership, you're going to be subject to the tax on your share of the profits of that limited partnership. And so you'll be entitled to any deductions, any losses that are incurred, or any foreign tax credits for any taxes paid. Now, generally speaking, when we're talking about US and Canada structures, entities that we just described, whether they're corporations, partnerships, or trusts under US state laws, they're generally going to be given the same Canadian entity classification. Again, just very high level here. But, most US states love creating variations of this. So then we have hybrid entities that can make these type of classifications cross-border more problematic. So just looking at the limited partnerships, there are variations to the limited partnerships. There's the limited liability limited partnership. There is the limited liability partnerships. Those are LLPs and LLLPs, which are created through different state partnership acts. What you need to know here is, these will get flow-through treatment for US tax purposes, but the CRA does treat these flow-through entities, hybrid entities, as actual corporations for Canadian tax purposes. So that can have adverse tax consequences for a Canadian partner. All right, well, the last one we're going to jump here, since we're already on the topic of fun hybrid entities, we're going to talk LLCs here quickly. Which
is probably the most common. If you go to a US domestic lawyer or consultant, I would say 90% of the time they're saying, set up an LLC.
That's right. They're very popular for American owners.
Yeah.
And the reason for that is, they're going to give you kind of the best of both worlds. You've got limited liability for all its owners, which includes the managing partner, but you're still getting a flow-through entity. So you're only getting one layer of tax at the partner level. And when you, as an LLC, if you have only a 100% owner, so one owner, it's going to be disregarded entity for US federal tax purposes. So that means, you don't have a US federal tax filing requirement, which, by the way, that's different. If you think about other flow-throughs like the S Corp to the partnership, here we're saying there's actually no US federal tax filing requirement. And the entity itself, so the LLC is actually not the beneficial owner of the assets that it owns. It's actually the single owner of that LLC that owns the assets and the income of the LLC. Now, the CRA has a different outlook on this. Even if the LLC is carrying on business in the US, if that LLC has, for example, mind and management in Canada, and let's say we're using the example of a sole owner of that LLC, that Canadian resident is going to be the sole member of that LLC, then it's not going to be eligible for the US-Canada treaty benefits. So it could be subject to double taxes. And what that means is that the CRA is actually going to see the LLC as a Canadian resident. And so it's also going to have to file Canadian corporate tax returns. That being said, now there are certain eligible entities that can also elect to have their tax entity treatment for US federal tax purposes. So you can have an LLC or a disregard partnership that can also be treated as a corp. Now those elections are binding for 5 years. The important takeaway with any of these hybrid entities is if you have a Canadian resident and they acquire interest in, whether it's an LLC, an LLP, or an LLLP, it's going to be treated as having shares of a corporation for Canadian income tax purposes, unless it elects to be treated as a corp for US tax purposes. So you have that mismatch.
Yeah, and I mean, there are times when some of our clients will use an LLC, but you have to stack to protect yourself. So it's, it's not that they're the worst thing in the world, but it is, you need to be really careful. And I know in advance of the webinar, someone asked about moving to Canada and they already own a company. If it's one of these S Corps, LLP, LLLP, or LLC, then you'll probably want to do some planning before you move up.
Yeah, and I would say even just from an accountant's perspective, when you're getting any of these informational returns, whether it's a K1 or whatever the case may be from those LLCs, you have to be careful because you're actually having to employ Canadian income tax principles for what's happening at that LLC for the Canadian investors and not looking at just the K1 as your
picking up the income. Yeah, that's right, which we see often, unfortunately. So, all right. So on to me now. Now that we know how to potentially set up or not set up, for that matter, or the legal entities, we're going to just talk a bit about distributing your profits to the US. So when you're down in the US, obviously the intention is you want to make money, which means you're going to hopefully have profits that you're trying to get back to Canada. Now, there's a number of different ways in which you can try to repatriate the money back into Canada. And some of them is through dividends. Maybe you have financing that you've set up to the US entity. So you'll have interest coming back. And if you recall, I said interest has no withholdings, whereas dividends has withholdings. Maybe there's a royalty on intellectual property that you want to look to charge, or potentially a management fee. And so all of these kind of come with their different risks, I guess, if you will, as well as benefits. And so dividends is one of the most common ones that generally we will see when you're trying to repatriate profits. And as I said earlier, there's a withholding tax on those dividends. If it's paid to a corporation, it's 5%. If it's paid to anybody else, it's 15%. And so those ones will come up. And in some instances, those can actually be tax-free if paid to an entity in Canada. So if you have a Canadian corporation that owns the US corporation and you pay that dividend, Canada might allow a deduction for that dividend. Now, in order to do that, you should be doing a annual surplus calculation to make sure that you have a surplus account in order to pay a tax-free dividend back to Canada, and make sure you do the withholdings. I think historically, people haven't been as forthcoming or cared quite as much about doing your annual surplus calculations, but recently the foreign reporting form in Canada has changed, requiring everybody to disclose this information. And the intention, I'm sure, behind that is to make sure that people aren't taking deductions for these dividends that aren't actually an eligible deduction. So that is one thing to consider that you have to do. And what the surplus account is basically taking your US, Namir, you alluded to it earlier, you take your US entity's information, convert it into Canadian tax rules, and see if there's enough retained earnings and profits there in order to repatriate the profits tax-free under Canadian law and defer the Canadian tax until paid out to the top shareholder. Interest is another one that's quite common, especially when you're doing financing, but this does come with some risks on both sides of the border. So depending on how the US entity is funded through capital and debt, you might have some denial of that interest deduction on the US side of the border. And then on the Canadian side of the border, you're going to be taxed even if you don't get the deduction on the US side of the border. So you really have to be careful about when you're doing a financing, how you're doing that financing and that you're doing it in accordance with the rules so that you get that deduction down in the US, because you don't want to lose that deduction when you have to pick it up and have mismatching. And as I said, interest doesn't have withholding, so it is a good one if you're trying to reduce the overall withholding rate and gross cash that's coming back to Canada, then you can do that. Now, royalties and management fees, I'm going to kind of lump together because those are also common ones that are used and may not be subjected to withholding. But the thing with these ones is you have to make sure you have a really good transfer pricing policy in place, because the laws of the different countries, both Canada and the US, have transfer pricing laws. And what those rules mean is that basically you can't pay yourself what you wouldn't be willing to pay a third party to do the same service or for the use of the intellectual property. And if you are doing that, they might deem it too much and deny either the deduction, or Canada on the flip side say, hey, you're not charging enough, we're going to deem more income in here. So I know we have a webinar coming up in a few weeks here, I think, don't we?
October 18th.
October 18th, perfect, with one of our transfer pricing specialists out of our office out east, Elizabeth, who we're going to talk specifically more in detail about transfer pricing rules and what you need to contemplate on that front. So I'm not going to go into a lot of details on the transfer pricing because that is coming up, but you really want to be careful when looking at management of royalties. Yes, they're great ways to repatriate profits. It'll be a business income in Canada, but you need to be very careful that you're laying out exactly why you're charging something, how much it is, who's doing the work, all of those different types of things to substantiate that it's actually a legitimate amount that's coming. The other thing you need to be, oh, go ahead.
Oh, sorry. So just to add to that, I think, a lot of these questions around, how are you distributing your US profits to your Canadian investors? These are actually important questions we want to ask clients when they're in this very early stages of structuring their business. Because we want to understand, how you structure that cross-border business. How do we create the flexibility so that you can get these distributions the way you're envisioning, whether it's a short-term or long-term strategy for your cross-border business?
Well, exactly. And that's a good point. I mean, generally, every time I talk with a client, whether you're a client yourself or a provider, the first thing I always say, and we started it with, what's your end game? What are you looking to achieve? Because that's going to dictate what you want to do today. Far too often, I think people go into expanding in the US and say, I've got an opportunity in the US, I'm going to set up a company, I'm going to make money. But that might not be the best answer depending on what your end game is in 5, 10, 15, 20 years as to where you want to live in the future. What do you want to sell your business? Like, all of these things need to be brought into play when you're trying to determine how to structure and how to pay money back.
Right, because they might even come back and say, hey, you know what? I actually think I'm doing okay on my month-to-month earnings. Yeah. Maybe I'd like to use these US profits to, build this conglomerate in the US. I'm going to build several different businesses in the US. Yeah. So let's retain these profits in some structure, whether that be a US structure or a Canadian structure, and those are going to be important questions because that's going to dictate how the structure is going to be the optimal setup for what their vision is for expanding. Exactly.
Yeah, you can always leave the money there. Nobody says you have to repatriate it under the rules. So awesome. Well, I think it's time for our next polling question coming up. And so our next polling question is, dividends paid to a Canadian corporation from an active US business are never taxable in Canada. True or false? This is our water break time, I guess.
I'm actually having my water.
Awesome. So that is false. Correct. So there, as I said, if you do not actually have enough of a surplus or taxable account, there is a chance that those dividends may be taxable by the Canadian entity. So most of you got that correct. That's right. The trigger words never. So those always are never always are not a thing in tax usually. So we'll move on now to what's our exit plan, Namir?
Fantastic. So, you actually alluded to this earlier, and it's always interesting when we're having these initial conversations with clients around, how do I structure my cross-border business? And then one of the first questions from us is, well, what's your end game? What are you planning to do in the long term? What's your long-term outlook for this business? And that's something that you have to really consider from the onset of expanding to the US. And the reason for that, if you're going to set up a separate legal entity, let's say you have a US entity from one of the entities we talked about earlier, shares of that US entity, for example, a US corporation, shares of that US entity is typically going to be capital property. So a disposition of those shares is going to result, in a capital gain or a capital loss. So I really want to know, when I'm talking to a client, it's almost like a Shark Tank session. I want to say, what is the prospect of growth for your business in the US? What do you think your US business's value is going to be relative to what you have right now in Canada, relative to your Canadian entity's assets? So when I'm looking at this, the reason we ask is we want to know, for example, when we're looking at their Canadian business as it stands today, is that Canadian entity eligible for what we call the small business corporation status? And so there's two ways you can get there. One is if it's a private corporation that's controlled by Canadian residents. So that's what you see as a Canadian controlled private corporation, CCPC. And the other one is an asset test. So I'd want to know if substantially all of the fair market value of that Canadian entity's assets are actually used in a Canadian active business or other corporations that are related to it. So the reason this matters, a Canadian company's status as a small business corporation is going to be essential if the Canadian owners want to access the lifetime capital gain exemption, and that's $971,000, I think, in 2023 for qualified small business corporate shares. So that $971,000 lifetime capital gains exemption, it's going to be available to Canadians at the time of disposition or deemed disposition of their qualified small business corporate shares when they recognize the capital gain. So the Canadian company needs to have derived also more than 50% of the value of its assets from an active Canadian business in the 2 years prior to the disposition of those shares. So how does this play out for our cross-border structuring? Well, let's look at it from the two different approaches we had earlier with different structure approaches. First, if you're operating the Canadian entity and you're doing business directly in the US, so you have a branch operation, you haven't actually done a separate legal entity, well, all the assets of that US branch, including, for example, goodwill, are going to be treated as ineligible assets. So the value of those US branch assets, if they are going to exceed 10% of the fair market value of the Canadian company's assets, well, then the Canadian company may not meet the small business corporation test. So you want to get access to that lifetime capital gains exemption when you actually sell the Canadian entity. Now, on the other hand, if you say, well, I'm going to operate my cross-border business using a separate legal US entity, not a branch, well, that separate US legal entity, that separate US entity that you have shares in it, that entity will also not meet the definition. Whether you have equity or debt in that US entity, those are also going to be ineligible assets for the small business corporation test. So it's going to be really important in the very onset of these conversations with clients when we talk about, how are you structuring your cross-border business, is really trying to understand what is going to be the prospect for the growth of their US business. And, if you have a Canadian entity and you've got this US subsidiary that becomes really highly valuable, we start failing some of those tests as a small business corporation. And this is, by the way, why we potentially could look at structuring alternative Canadian entities to help protect access to the long-term capital gains exemption for Canadian shareholders. But again, you want to evaluate that against any added administrative and compliance costs with setting up a separate Canadian entity. The other exit consideration here is around estate taxes. So if the US company shares are owned directly by an individual, there may be US estate tax considerations. Now, this is generally applicable to high net worth individuals, but the key here is, even if you are not a US person, you're not a US citizen, you're not a green card holder, the US estate taxes can be triggered upon death if the individual owns property that is considered to be in the US and meets some other criteria. So the way the US estate taxes work is you're going to be taxed on the fair market value of the deceased's taxable estate. So if you have shares of a US corporation, regardless of where those shares are held or traded, or for example, if it's a pubco, they're going to be part of the deceased's taxable estate that is subject to US estate taxes. Now, on the other hand, shares of a Canadian company are not considered US situs assets, so they're not going to be subject to US estate taxes. Now, the good news here is that the US-Canada Treaty does offer some relief here in that when they're looking at the value of your worldwide assets, they actually have to exceed 12.9 million US before you're subject to any US estate taxes. And the marginal rate can go as high as 40%. But one key thing to remember here is even if your worldwide assets are not that high, if your US assets are still over $60,000 at the time of the individual's death, you may still have a US estate tax filing requirement. Now, the other thing, when we're talking about cross-border structuring with our clients, again, we're talking inbound Canada to the US. And we've talked about this really from the lens that we're dealing with Canadian shareholders, we're dealing with Canadian citizens, Canadian residents. One question we often talk to our clients is, hey, do you have any plans to move somewhere sunnier, somewhere warmer? Are you or your family looking to move to the US anytime soon? And that could be, by the way, for personal reasons, business reasons, but what are your long-term plans? Do you want to stay in Canada? And we do have to ask this because the structuring options that are available to you, even the ones that we just talked about today, are really going to change, and your answer is going to change if your tax residency changes from being a Canadian resident. So that could create a very different answer in terms of what is going to be the right structure for your cross-border business. And also, by the way, it can also include some great tax planning opportunities for you as well if you're planning to move to the US. So I'd want to know if you are moving to the US, that we can ensure we have you in a cross-border structure that has that flexibility, and doesn't end up in a bad tax result. Because now, for example, let's say you're going to the US. Well, now you become a US resident owning a Canadian parent company that then owns a US structure. That's not where you want to be if that's not the result that you were planning for. And then the other variable I want to add to this cross-border equation, because, again, a lot of our discussion today focused on Canadian shareholders' perspective inbound to the US. But, and Krista, you can add to this, is, more often than not, the fact patterns that come to our desk are not as vanilla. It's never as simple. Canadian investors Canadian investors generally come to us and say, hey, you know what, I'm in the tech sector. I'm going to bring in some US investors. I'm going to bring in some international investors. So it's often not just Canadian investors you're dealing with. So that alone, let's say you have, for example, other US investors in the picture. And let's say, for example, those founders or investors are going to be controlling the entity, or they're going to be the majority shareholders. That alone will also break the Canadian entity's ability to meet, for example, the small business corporation test. And another question we'll also ask clients, again, just kind of looking at the long-term outlook, is what is your anticipated exit for this company? Are you looking to have a US company or US investors acquire you? Or maybe when you're looking at the Canadian business versus the US business, are you thinking, maybe down the path, you're going to say, well, maybe we're going to eventually shift the company's operations altogether to be primarily US based? Those are the type of questions all around. And it's really difficult because you're talking about the end game on the very first stages of structuring your cross-border business, but they're going to be critical to understand what's the right setup and how do we add the flexibility to get you the optimal result from a cross-border business. And
yeah,
that's
it. And the one thing we need to really, as we always say, is what's the end game? And that's really important for everything, whether it's how are you repatriating or not repatriating? How are you setting up your structure? How are you employing people? How are people working on different visas? Like all of that comes into play when you're looking at what's your end game of your business. And it could be a 20-year end game, but you don't want to set something up that in 10 years you have to redo because you're looking at doing something. So it's your business plan.
And, it's funny because I think, we are talking tax.
Yeah.
But at the end of the day, you can't not bring the personal story into the conversation.
That's right.
Thinking about,
exactly.
What are your long-term plans? What do you want to have with this business? Is this going to be, a wealth generation vehicle for you and your family? Is this something so down the path you're going to move to the US? All those need to be part of the conversation so we can give you the best overall answer.
Yes, exactly. And so just kind of wrapping up our technical component here, I'm going to spend a couple minutes just as I alluded to the reporting in Canada once you decide to expand into the US and what you need to keep your eyes on if you're doing that. And so the first one is the information return for transactions between companies. So this one has $1 million threshold. But the $1 million is, change in debt levels, change in receivable levels, change payments that are made for management fees, royalties, rents, interest, dividends, etc. If those add up to $1 million, you have this reporting obligation that you need to do. And this is on a form called T106. The next one is the information relating to controlled and non-controlled foreign affiliates. So this form changed a couple of years ago from a 6-page form to a 16-page form, as I talked about with the surplus and all of the extra information. Canada is not alone in this initiative that they're doing and trying to capture what is happening outside of the country. The US reporting is actually still much more intensive and complex than Canadian reporting for non-Canadian entities. But this one is if you own an interest, and generally we look at 10%, you have to report a T1134, your ownership in this interest, the type of income it earns, the activity that it has, how much profits it has, et cetera, and your interest in it. So you want to make sure that you're filing those forms. Now that one has a threshold as well, generally about $100,000 for revenue and reporting. There is different, if it's a dormant, it's a different type of detail that you have to do, but make sure that you are reporting those. Both of those penalties are, those returns, as well as the foreign income verification statement, they all have penalties because they're not actually tax creating, they're just reporting information purposes. And so each one has up to $2,500 penalty per year per form that needs to be paid if it's not timely filed. The last one there is the foreign income verification statement. That one is, let's say you own a minor interest in a corporation, or you have US funds, or you have even public company for individual stock in your Canadian bank account. If you have that over $100,000, you have to report the foreign T1135 is the return for that. On your return, right at the bottom of your name, it says, do you have greater than $100,000 of foreign property? Shares of a non-Canadian corporation is actually foreign property. So you have to say yes and complete this form. And then the last thing I'm going to bring up is the foreign accrual property income. So what this is Canada's deemed income inclusion, if you will. If you own a US entity, and going all the way back to our presentation at the beginning, passive versus active business, if you have a US entity that's main source of business is actually passive, Canada has a rule that you can't leave those profits in the United States. You're going to, for lack of a better term, deem repatriate those profits into Canada, and you have to pay tax on those on an annual basis. US has a similar rule called Subpart F. So every country, again, has similar types of rules that they don't want you setting up offshore, out of country entities to hold passive income to avoid Canadian tax. And so this one is, you have to deem the inclusion. You're allowed a deduction for the tax that's paid in the United States, but you really want to manage this one carefully, because if it's not managed appropriately, you could actually expose yourself to double taxation, because it is a deemed, anytime you have a deemed income inclusion, you're exposing yourself to double taxation. So you have to be very careful in how if you're looking to keep passive income, and you could have a corporation that has both active and passive income. And so you will have to segregate that passive income and do the calculations under the foreign accrual property income rules to see if any of it's deemed repatriated to Canada. So it's just something to keep in mind when you're looking to set up offshore as a different legal entity, whether or not you have any reporting that you have to do in Canada. If you set up U.S. partnerships, those would go on the T1135, the foreign income verification statement. So just depending on what type of structure that you use and what type of income that you're earning will depend on what type of reporting you have to do in Canada for this new non-Canadian business that you're operating. Time for our last polling question here, and then we'll wrap it up and take some questions. Canadian resident individuals directly owning shares of a U.S. corporate entity will not be subjected to U.S. estate taxes. All right. So if you're a Canadian resident, yes, you will be subjected. So that is correct. It's false. You may not have to pay taxes, but if you're an individual that owns U.S. corporate entity shares, you are brought into the U.S. estate tax reporting regime. That is correct. And so I think that about wraps it up for our technical component of it. If you want to wrap us up here, Namir.
Right. So, I mean, we touched on a little bit of each of these different topics, but again, within an hour, you do have to stay at a very high level overview. But the good news is, with the BizTax webinar series, we actually are going to do a little bit deeper of a dive into any one of these topics. So the next one upcoming is the transfer pricing for BizTax. That's going to be on October 18. But we're also going to talk about cross-border employees. So if you have, employees from the Canadian entity that are going down to the US, US federal, state tax incentives, and a bit of a deeper dive more on that exit plan and how you plan to sell your business. Now, if you do have any other topics in the area that you'd like to offer as suggestions, please let us know, and we'd be happy to take that on. All right, awesome. I think now we're moving into the Q&A sessions. So
sure. Yeah, if we will, and make sure to complete the survey if you have time. It should only take you a few minutes. It would be great if you could just also do the survey for us and let us know those topics you'd like covered or what we can do to improve for these future webinars. And here's a couple of QR codes if you're looking to register for some of our the next two. One is Tax 101 on state tax in the United States on October 5th, and then on October 18th, as Namir said, the transfer pricing. So Gina, do we have any questions?
Yes, we have received a number of excellent questions. While we aim to address as many as possible, time constraints may prevent us from covering all of them. Rest assured that we will consider all submitted questions for future webinars. And here's my first question. My understanding is that if a Canadian wants to open a business in the US, they can only do so by incorporating an LLC. Can you explain any restrictions for Canadians in setting up US entities? And do you have a preference recommended a special type of entity?
Well, as we said, I think US people like to say the only option you have is an LLC, but that is certainly not the case. I think, as Namir said, the C corporation is generally the preferred way if you're setting up an entity. If you use an LLC, we didn't talk about it today, but there's something called check the box election to have it treated as a corporation. But even in those instances, you can have risk. Namir, do you want to add anything?
That's right. Yeah. I mean, I think if you're going to have, often the reason the LLCs also come up for Canadian investors is maybe you have also US investors in the picture. If you don't, I mean, generally, I wouldn't look at having a direct ownership into an LLC without looking at the check the box election. That being said, that doesn't mean that the LLC is always a bad answer. And there are ways to still structure your business. So you are in the US with an LLC, but maybe not through a direct ownership of the LLC as a flow-through entity.
Correct.
Okay, thank you. And the second question, my Canadian corporation is a holding company with the investments, including US partnership. Given that it only receives passive income, such as interest and rental income, I believe there is no US filing requirement. Is that correct?
Sorry, say that again. It's a Canadian?
It's a Canadian holding company with the investments in US partnership.
So they receive a K-1, I'm guessing, from the US partnership that has interest and dividends from what I heard, right?
Yeah, I would assume
okay.
so.
Okay, so no, that could be false, depending on what that interest and dividends are. As I talked about in the active business, there is times when those businesses are actually still an active business. You need to truly understand what the underlying business is of that LP to determine if there's a filing requirement or not. And so the one example I gave earlier is if you're invested in something that's in the business of lending money and earning interest, it might be actually active business income in the United States that has a reporting obligation. Now, I don't know if you have enough information to know what the actual business is of the U.S. partnership that you're invested in, but I would probably look into it because you might actually have a reporting obligation if it's active in that business and not passive. Now, if it's passive and you had the tax withheld on the dividends, then correct, you don't need to file anything. But chances are, if it's on a K1, they may have miswithheld. It really depends how the K1's been completed, to be honest, to determine whether or not there's a reporting obligation.
Yeah, just to add to that, Krista, yes, I think, you often, as a Canadian investor, and you're invested through, let's say, a partnership in the US or other business in the US, if you're getting that K1, that's not your be all end all. I don't think it's your final answer. You really do need to understand what the partnership is doing. You'll also find that the US, from the US perspective, the partnership might also be providing you with forms to figure out what the withholding requirements are going to be for them as they're distributing that income to you, so that they know whether they've withheld the right amount for you as a non-US person, so as a Canadian investor.
Awesome. Maybe we'll take one more here. We're just past 11. We'll go with one more question for now, Gina.
Okay. We are a Canadian remote-based luxury travel agency. Many clients based in the US and travel advisors in the US that are interested in joining our business. Would you say having a US entity provide any benefits to our company?
Well, that's a pretty loaded question, and we'd probably have to look into a little bit more details. If you're looking at investors, maybe they probably want to invest in a US entity, not a Canadian entity. Depends how you're doing these services in the US, whether or not you have a permanent establishment or not. I think there's a little bit too many. It depends on that one. It might be a little bit specific, but Namir, do you have anything else to add?
I think there's no one size fits all. I think part of our today's discussion is really seeing that there's so many different drivers that go into that final answer to say, hey, here's the optimal result for you if you're going to set up a cross-border business. So, and by the way, that's not all tax either, right? Like some of it is the financial considerations, some of it is the legal considerations. Is liability an important issue for you? Is that something inherent in the business that you do? So there's a lot of different drivers that go into that. And I think part of having these consultations is understanding what are your business objectives, what are your tax kind of overall drivers there, and then what are your personal, how does your personal picture fit into all this to make sure that it works for you and the US investors?
Exactly. Awesome. Well, if there, as Gina said, if there was questions, I know there was probably some questions we didn't get to. Hopefully we can answer them on future webinars, or one of us will reach out to you to see if we can assist you if it's a fairly basic question and get back to you. I want to thank you for joining our webinar today and listening to us talk more tax. And thanks, Namir. It's a pleasure presenting with you as always. And until next time.
Thanks, everyone. Thank you, Krista, and take good care. Bye-bye.